Hi for everyone. I'm Akshat. I'll be your host for today. And in fact, along with me, I do have Gautam today. He's going to be the co-host. Oh, I just see got dropped. He'll be back soon. But he's going to be the co-host. He is my co-founder with Pennywise, and together we are going to add anything and everything we can today to your knowledge, to your tidbits around personal finance, right? So I will go ahead and share my screen right away so that we can get started with the session. Some of you have already filled in a pre-workshop questionnaire, but those of you who've not, we'll just get back to it once again. But yes, that's the topic for the day: financial reset for FY26. Taxes, whatever new changes have been done, does that do that impact us or not? That's something that we're going to talk about. Planning, investment planning, as always, and then some smart money moves that we can actually make to do it, right? Yes. So, quick disclaimer before we get started with the session. We do want to call out that. Okay. Now I hope it's okay. Okay. Yeah. Quick disclaimer before we get started. I do want to call out that we at Pennywise are financial educators, and in no manner are we endorsing or trying to sell you any financial products, right? All we want to do is educate you with the right tools, with the right means, with the right skill set, so that would help you take your money decisions better. At the same time, we might take an example of a number of products or companies that offer such products, but in no manner are we affiliated to any one of them. As I said, all we want to do is give you the right tools, means, and the ways to take decisions on your personal finances. Cool. Okay. Before we get started, I know some of you already filled in the pre-workshop questionnaire, but those of you who've not, I will request you all to quickly take a minute. Should not take you more than a minute. Just take out your mobile phones. You could scan the QR, and then we will look at responses all together. We're going to see. So, as much as we want to try and simplify all that we have prepared for you today, there could be, since we've done a number of sessions, mostly most of the sessions that we've done previously are all hosted on Ethika's YouTube channel, right? So all of you can go and access that, and Ankit will share the link to that as well at the end. But okay, let's look at the responses together, right? So what do you think is your understanding on the level of taxes? 37% say I blindly outsource it. About 62% say I can handle my tax planning with little help. And I believe this is about just about 1% who feel they are, they're really good at filing their own taxes. Glad to see that. Glad to see that. Um, have you ever compared tax liability under the old versus new regime before filing your ITR? So 70% of you said yes, you do. Very nice. And 30% of you said you don't, but that's okay. And about, I think, 1% says my tax advisor takes care of all of it. But that is okay. That's a little fun. The first one is 40 people say I blindly outsourced it, but then only 1% feel their tax advisor takes care of it. So if you outsource it blindly, then why do you calculate? Just kidding. I'm just trying to look at the responses in a fun way. What is the main focus while selecting the asset class? Overall, about 60% overall balance all across. Very nice. 20% have a familiar option investment, thoughts, and about 24% would want to invest in a high return investment class. And what when one part of your portfolio performs well, what do you usually do? Invest more in that asset. Very distributed response, equally distributed. So 27% say I invest more in that asset. 22% of you I leave it as is. I book some profit, and about 30% of you are not sure. Very nice. Very nice. I think I loved the responses. Super amazing. I think it's going to be a lot of fun. So one of the things, folks, that I want to actually tell you guys is, you know what? I'm a late riser, and you know what Ankit always does is he always wakes me up early, much earlier before the workshop. That's why we need to do a test run. We need to do this. We need to do that, and therefore I've not been able to have my breakfast. Okay. So now, if you want this energy to stay like this till the end of this session and you want to have some fun in this session today, I want to see how excited are all of you. How excited are all of you? Drop some emojis. Let us feel the energy in the room. And together we are going to have a lot of fun. Oh wow, Revant, thank you so much. I'm gonna have that apple for the breakfast. Lovely. I see some smileys now coming in. Wonderful. So I think that's going to be the fun part, right? All we want to do today here is obviously we want to teach you a lot of fun financy things, but at the same time we want to have a lot of fun, right? So keep the chat buzzing, ask as many questions as you want to. We will stay for as long as you want all of us to stay, and we will make sure that we give you all the understanding you need for this subject, right? And at the same time, let's have fun. Cool. Okay. So this is all that we've planned for you. Why April matters, starting the new financial year, old versus new tax regime, what has changed and what should you check in FY26 now, impact of the recent changes and updates related to the Income Tax Act of 2025, investment planning for the new financial year. What should you review? How should you, for those of you who are already investing, what should you review? How could you rebalance your portfolios? And for those of you who are new to investment, how can you get started with your investings? Markets have been falling over the last couple of months. They've recovered slightly, but post the ceasefire has been announced with the current geopolitical situation. But what are some of the smart strategies that people who are investing can actually use? And then some of the common mistakes to avoid. Cool? Even more excited? After looking at the agenda? Yes, no? Let's go. I think we should put in the chat, let's go. Okay, okay. So now that we begin, why April matters. Starting the right financial year. That or starting the financial year right. Thank you, thank you. Love the chat. So, question for all of you: why do you think April matters? Ah, I love Navya's response with the car racing flags. Why do you think April matters? Chalo, question change. Acha, some of you are responding only to hosts and panelists, huh? So just go on to your chat and you could change it to everyone. So then everyone sees your responses. Okay. So new financial year, new opportunities, start early, planning ahead, investment declaration, declaration of tax, new financial year starts. IPL season, I like that. Prashant is saying April Fool. Very nice. No, we don't have to become fools. New financial year, new investment, hikes in salary. Ah, hikes in salary. Prachi got that right. Because beginning of new FI, early planning, avoid tax deduction, have to plan for the new year taxes, choosing regime, strategy for the year, new tax code. Excellent, excellent, right? So many valid answers, so many valid answers. But you know what? Honestly, this is my take. Okay, this is my take. Proper, fruitful planning for FY. Save tax and plan trips in December. Ah, I like that, Prashant. And then also utilize your credit card points to get rewards on the trips, right? We've done a session on credit cards as well. It should be there somewhere, but it's been a while. It's been a while. Okay, okay. Coming back to this. So honestly, this is what I feel. It does not have as big as an impact as we think. Read that again. What I feel is that financial year, the new financial year, it does not have as big an impact as we think. And why do I feel so? Why do I feel so? I feel so because I feel it only acts as a reminder to those of us who keep procrastinating. Just like the 1st of Jan, we make a lot of resolutions. And then by the 10th of Jan, we even forget half of those resolutions. A lot happens with our financial goals on the 1st of April. And then we forget most of the things as soon as we submit our declarations to the office. We get our hikes, we do some parties, and then we all forget about the goals, the planning, the investments that we had to make, so on and so forth. Yes? Do you all agree? Does this happen? Yes, no? Yes, no? Yes, exactly, right? And so, the reason why we are doing this session today is that you don't ever again have to think of 1st April as a new milestone, right? what all of us should actually think of, and as much as once we go deeper into the session today, we're going to talk about it. But there is only one rule with finance. There's only one rule with money, which is consistency. Consistency beats anything. You know what? There was this recent survey done, and I will show that slide to you after we've done the first part. But there was this survey done that what can a consistent investor achieve, which a non-consistent investor or an inconsistent investor was not able to reach or achieve, right? But we're gonna come back to that in right some time. First and foremost, it's the tax that we need to talk about. And for that, I will welcome my co-founder Gautam, who is an excellent certified financial planner with an MBA in finance. He is my finance guru. I have learned all my finance from him. I, in fact, come from a non-finance background, right? But that's a story for later. So first, we will pay all our attention to understanding taxes, and then we will move on to the further topics that we've planned for you. Right? Gautam, over to you.
Yes, thank you, Akshat. Thank you for the credit. And a very good morning to all of you. Thank you for joining the session. So we'll start the session with the taxes actually. Right, great. So, without taking much time, I'll start with the tax part first. So, we will in tax part we will be covering the recent changes which has been introduced uh, for this financial year or the coming assessment year and all. So, when we hear the word financial year, assessment year, we get confused. So, there is some changes around that as well. There are some changes where there is a financial impact on our income, but most of them are non-financial in nature actually. So we'll see all of these. But before that, we had a question in our pre-workshop questionnaire that how many of you uh, calculate your tax outgo, right? Like comparing old regime versus new regime, how much tax outgo will be there if you go for old regime, obviously with the deductions, what you can avail the exemptions, new regime, how much the taxation would be that the tax outgo, right? So we'll see that first. So before we move on, so these are the slab rates which are applicable in the old regime, right? So 2.5 lakh slab is there up to
Gautam, if
two
you
and a
could just
half lakh.
put it on 150%.
So there is an old regime, up to 2.5 lakh, there is no tax, and then 2.5 to 5 lakh, 5%, 5 to 10 lakh, 20%, and but then more than 10 lakh, 30%. Most of the people, I won't say most of the people, but some of us have this confusion, and I think including Akshata as well, right? Sorry, Akshat, for bringing that up. So Akshat was like, if I am having an income of let's say more than 10 lakh, so let's say 15 lakh. So on the entire 15 lakh, I'll have to pay 30% income. So it is not like that, right? You have the brackets. So on let's say you are earning 15 lakh rupees, right? So first 2.5 lakh, you don't have to pay income. The next 2.5 to 5 lakh, that is 2.5 lakh amount. So on 2.5 lakh, you have to pay 5%, and 5 lakh to 10 lakh, that is 5 lakh rupees, right? So on that 5 lakh rupees, 20%, and then up whatever you are earning over and above on that 30%, right? So it is incremental in nature. Right. So this is the tax slab rates in new regime. So we have 4 lakh, bracket over here up to 4 lakh nil, and then it goes to 30% if anyone is in the bracket of earning more than 24 lakh, right? So this is the tax bracket. So we have created a calculator for you. So where you can use this calculator and then compare what your tax outgo could be in old regime and new regime. Right. Before I move on to explain this tracker, once you get access to this tracker, right? So don't ask for access for this actually this Excel sheet, Google sheet. What you can do is you can see the file functionality over here, top left corner, right? You click on file and then make a copy, and then you can, edit that sheet actually. So you don't have to ask for access, right? Simple. So now, gross salary, these are the input fields, right? So you just put in your gross salary. In the gross salary from your pay slip, you can check your basic plus DA. You can see here if there is any NPS amount, right? If your employer is contributing. It is important here, your employer. Why? Because in new tax regime, whatever your employer is contributing, you get tax benefit there as well, right? So that's why we have given NPS ka provision as well here, right? So if your employer is contributing towards NPS, so you can put it here. You just put the percentage amount. Uh, the contribution exact amount will automatically be computed, right? So you can see these colored cells, right? So in these colored cells, only you'll have to put the amount. The non-colored cells will automatically be computed, right? And then there is a standard deduction. So I'll just show you. So in old regime, there is standard deduction of 50,000, right? If you change it to new regime, automatically it will change to 25,000. So what is standard deduction? So you don't have to do anything about this. What government says, what income tax department says, ki whatever your income is, we will simply deduct 75,000 from your income. So your income gets lower by 75,000 in new regime, and in old regime, it automatically gets down by 50,000. And then all the computations, if any deductions is there in old regime, that will be computed. So for this standard deduction, you don't have to do anything, right? So going by old regime, 50,000 deducted from your salary, gross salary of 20 lakh, it comes to 19 and a half lakh, right? So we have given again provisions for putting the this deduction amount, right? So we have put here most of the widely used deductions, right? There are multiple uh, deductions available, but most of us what we use, right? We have provided here. So 80C, which has a maximum limit of 1.5 lakh. Similarly, 80D, which is for medical insurance, right? And then education loan if you have any, and then you can put, and then if you can see, the notes here. So we have provided that as well, like in 80C, this 1.5 lakh amount, what all kind of deductions you can avail in 80D, right? So 1.5 lakh is not for if let's say for example, if you are paying 80,000 for you and your family, right? So entire 80,000, you won't be able to avail it, right? Because there is a limit of 50,000. The remaining 50,000 is for your parents, right? Again, there is a sub bracket there. So if you are of less than 60 years, then the limit is 25,000. If you are of 60 years and above, then only that limit is 50,000, right? So we have given these notes as well. You can refer it, right? Similarly, for education loan is there. If you have any home loan and you are paying interest on it, so here also we have given some notes provided you, right? So in this 80C, you can put maximum 1.5 lakh. For 80D, maximum 1 lakh you can put. For home loan interest, how much you can put. And then NPS if you are contributing on your own, right? So additional we get 50,000, right? Under section 180 CCD 1B, right? So you can put it here. HRA exemption is available here. So HRA uh, calculator we have provided here, and there is a change in HRA, for the people living in Bangalore, Pune, Hyderabad, and Ahmedabad, right? So we'll see that as well when we talk about the changes, introduced from this year, right? So HRA calculator also we have provided here. So automatically it will get fetched how much HRA exemption you can claim it. So total deductions automatically it will be computed. So your total taxable income comes to 14,81,000, right? So this is considered given that you are selecting old regime. Now, if you select new regime from the drop down, you can see here your total taxable income, right? Now, automatically, what will happen here? You see old regime, if you have put the deductions. So in this old regime with deductions, automatically your tax outgo will be computed here in, this cell, final tax outgo old regime. So 2.5, 2.5, 2.59 lakh is the tax outgo in this regime. Similarly, if you are selecting, sorry, this was old new regime. If you select old regime here, so you can see the old regime. This is the tax outgo, 2.67 lakh, right? When you select new regime from here, so again, if you scroll a bit, so new regime you see here, and then this is the tax outgo, right? So 1.92 lakh is the tax outgo here. So using this calculator, basically you can simply check, you just have to input as less information as possible. Yeah, we have made this super useful, super friendly. There is some, I think, some issue with the formula. We'll get this fixed, don't worry. So you can simply see, you don't have to do any computation and all. You can simply compare what is the tax outgo in old regime, given that you are using, the deductions provided. And then if you are using new regime, so how much will be the tax outgo? It will be very easy, super helpful for you to compare that whether you should go for new regime or old regime. So this is the old regime versus new regime comparison sheet.
I hope you're able to see it, the presentation. Sorry.
Yes.
Yeah. And then, folks, those of you who've made a copy to the tracker, I'll once again suggest you can delete that for now so that we just fix the calculation issue and then we will reshare the tracker with all of you.
So now we will come on to the recent tax changes and updates, whatever we had recently, right? So we'll see that. So we have listed down, major five changes. Most of them are of non-financial in nature, as I earlier said. One or two of them are financial in nature. That means there will be a financial impact on the taxes we pay, right? So, before we move on to see those changes, question is why that changed basically, right? So, earlier tax act, right? So it was called Income Tax Act 1961. Now it will be called as Income Tax Act 2025, right? So in the 1961 Act, it was quite old. In that act only, there were a lot of changes, being done. So in that act, whatever sections were there, any new change, the sections were, it was sections where it was kept adding on, adding on. So in that act, Income Tax Act 1961, there were 800 plus sections. So it was giving more and more scope for interpretation, right? Interpretation of our own, raising more and more legal disputes, right? So reduce those legal disputes. Income tax department said that we will overhaul the act itself, right? So that's why they call it Income Tax Act 2025. So they have done this to reduce legal disputes, ease of compliance for people, for us, right? And more importantly, it has been done to make it more understandable for us, right? Most of us are scared of taxes. The moment we hear the word tax, right? Literally, we start shaking, we get our cold feet. So we understand it, it is more important, right? So that's why it was done. Um, Now coming on to the change, yes, actually. So we'll move on to the change. So first change is simplification of income tax act, right? So we always hear assessment year and then financial year or previous year. So if we are earning salary in this financial year, and then what would be the assessment year? In assessment year, you'll have to pay this much tax. In financial year, if you're earning this will be the slab rates and all. So we get confused most of the times that what is the financial year, what is previous year, what is assessment year, right? So
Yeah.
what the
How many
department
of
has
you have
done,
actually gotten confused? Let's ask in the chat. How many of you have
yes,
always gotten confused? What's this AY? What is this FY? Always, right? And I'll be honest, even me, I have never been, I have always been confused. And sometimes, always, yeah. Exactly. So now I think from now on, with this first change, that confusion is going to go away.
yeah, so financial year, tax year. So these words will be replaced with tax year. So there is no segregation of financial previous year, assessment year. There will only be a tax year. So every financial year will be called as tax year. So you don't have to be scared of anything there, right? So for example, let's say, we are currently in the financial year of 26-27, right? So even me, I used to get confused that whether this is financial year 26-27. which is the year. So sometimes I get confused of which year itself is this, which calendar year basically, right? So what I started doing is, so financial year 26, right? So 26 means it starts from 1st April 2026 and ends on 31st March 2027, right? So that mental thing I also used to do, and most of us do this, right? To understand this, so that we can make our tax assessments accordingly, right? So there is nothing financial year, previous year, assessment year, simply will be called as tax year. So tax year 2026, 27, tax year 27, 28, tax year 24, 25, like that, right? So there is no confusion at all. Again, as I said, this is non financial impact, nothing to be worried about, nothing to be done from our side, right? So we can move on to next change, Akshat. Change two, again, nothing to be worried about, but we must know, like Form 16, we all get Form 16 everywhere from every year from our employer, right? So Form 16 has been named to Form 130 for salaried employed, those who are professional or self-employed. They used to get Form 16A. So that has been named to Form 131. 26A has been named to Form 168, and Form 15G, 15H, the form which senior citizens used to get deductions on the TDS, like on fixed deposit interest or so. So that form has been renamed to 121. Uh, some sections like 80C will be now called as 123. 80D will now be called as 126, right? So when you get Form 16 this year from your employer, don't fight with your employer. No, 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 in the you know the session, Gautam and Akshay told that Form 16 will be named to Form 130. So this again change will be implemented in next financial year. Okay,
Next
so
tax
sorry
year,
about using that.
right?
So basically next tax year actually, right? So next April onwards, when you start getting Form 16 from your employer, so it will be named as Form 130. This year it will be called as Form 16 only, Form 16 or OTC only,
Right.
right?
And same
There is
goes for all
no,
the sections, all the forms, everything, right? So this year, when you are
yes.
filing your taxes, it is all ATC, ATD, Form 16, so on and so forth. But next year, which is
Mm,
2027 onwards, all of these will get renamed.
yes, thank you, Akshat. Let's just give me a minute.
Part A and Part B. So, Revit, the Form 16A is usually for professional. It's a broken. It's two parts of the same form. To be very honest, I mean it's just the way the information within the form is structured, right? Because
Yes.
there was a
So
question on Form 16A versus 16B.
Form 16A versus 16B.
Yeah, I mean, usually Form 16 comes to us in
16B,
two
I'm not
parts, right?
sure of.
16A and 16B. So yeah, that's what I was saying that
Yeah.
it's just two parts of the same form with some information in 16A and 16.
Yes, correct.
Yeah, only few of
No.
them get 16A. Yeah, don't get confused, guys. It will not be applicable to all.
Yeah, given that, ATC has been named to 123, ATD to 126. Don't think that there might be any change in deductions or limits. So there is no change in deduction limits. ATC or 123 will still be having the limit of 1.5 lakh. No change in tax slab rates either. So whatever slab rates I have shown to you in no new and old regime, it is still there, right? So we can move on to next change, Akshat. Yeah. Thank you. Right. So next change is for ITR deadlines and the revised returns. This could be important for some of us. So for salaried employees who are salaried, right, 31st July is the actually every year, 31st July is the last date to file their return, right? So there is no change there. For professionals or those who are self-employed, earlier the last date was 31st July. There is a 1 month extension. That means from now onwards, 31st August will be the last date to file returns for self-employed, right? For revised return, so if we have made some mistake while filing the return, income tax department had given us 5 extra months, right? After July. So till December, we could file the revised return. Now it has been extended till March of next year. So let's say if we are filing income tax this year, so 31st July is the last date, 31st July 2026. So was the last date. If you want to file the revised return, 31st December 2026 would be the last date, right? Now government has said, or the income tax department, that 31st March 2027 would be the last date to file your revised return. But it comes with a caveat. Caveat is that if you are filing your revised return after 31st December, you will have to pay a small penalty. But you have the option, you can file the revised return, right?
So basically, there is a small extension given. Earlier, it was till December. Now it is till March. However, you can still file the revised return till December, which is a good practice. The only thing is, if you file it after December, before March, you will have to pay an additional penalty along with the revised returns. But yeah,
Yeah,
let's get our returns right in the first go itself. Let's not even think about going for
correct.
revised returns, right? So,
So that's why don't wait for the month of July, actually, that, once July will kick in, and then, we'll get the pressure, and then we'll start collecting the documents, our investments, and then on 31st July, when system, IT income tax department system is not working properly, uh, I'll fill my income tax. So don't wait for that. You can file as soon as you get Form 16 from your employer,
correct, correct.
right? So moving on to
And
next change.
sorry, there's this question from Chaitali ji. I think we can take it right now. ITR 1, 2, 3, and 4, how to select it? Uh, so Chaitali ji, it depends on the kind of income that you have. So if you're a salaried individual, along with no other income or no other investment income, and so it's going to be majorly ITR 1, and then ITR 2 has some additional sort of incomes if you have, and then so on and so forth. So we usually do a session around tax filing before July. So, all of those things will get covered. Don't worry about the filing part yet. ITR 1, 2, 3, 4 you will have to understand it from the perspective of what's been your entire income for the previous financial year, right? And on the basis of that, you can I mean, on the basis of that, you can file it, right? And Gautam Revant has a question: is the dates for ITR 1, 2, 3, 4 all same? So I believe
Yeah,
yes.
it's same. Form ITR 1, 2, 3, 4, there is no separate deadline. So it's same. Yeah. So change four. So this is important actually, and this is the most impactful. So those who have been, investing in the stock market. And when I say stock market, it's investing, not trading, right? So those who have been investing, so that this is a important change. So buyback, right? So before we move on to the taxation part of buyback, how it has been changed, I'll just take a minute to explain what buyback is, right? So let's say you have bought a share, a stock of, let's say, TCS. So again, not a stock recommendation. Don't go buy TCS stock, right? So let's say you have bought a TCS stock sometime back, and now what company has said is, boss, if you are holding TCS stock, we would like to buy back from you. Now you might say, Ki, why should I sell it to you? I can sell it in the market, right? Using my brokerage and the securities account, right? So what company says is, I'll give you a little premium at the price what currently the TCS stock is trading in the market. So let's say company TCS says that 5% premium will give you. Like, so if you are willing to give those shares back to the promoter, to the company, that too you are getting a 5%, 10% premium, right? So basically it is a sell of stock. You get some amount there. So earlier what it was used to happen that whatever amount you get, it was added back to your income and then taxed as per slab rate. Now imagine those who are in the higher slab rate, right? The entire buyback amount was getting at the rate of 30%. It was like huge tax. What now government said, see, what we'll do is whatever the rate at what you have bought that stock, that will be considered as a cost, right? Whatever the price at what you have, given back those shares to the company, that will considered as a sale price, right? The difference, it is capital gain, right? The usually it happens for all the buy and sell transactions in stock market, right? It will be treated same. So it will be whatever gain you make on those buyback shares. So it will be treated as capital gain, and will be taxed accordingly, right? So you get the benefit of 1.25 lakhs, no taxation, and whatever the gain you make over and above 1.25 lakh, it will be taxed as per 12.5%, right? So this is a great move actually, right? So this is the change, financial change, I'll say, where investors can benefit. So this was a change four. Moving on to change five.
And
So
again,
this
I
is
just wanted to
also
call
of
out that this one might not be applicable to all, right? So this is only for people who are invested or buy stocks, and you know they are invested in the
yes,
stock market. So if it don't worry that this is not related to income tax. This is related to your
and right,
investment tax. Yeah.
right. Coming on to the next and last change, right? So we had, multiple allowances which we used to get from our employer, right? Children allowance, hostel allowance, and all free meals we have, right? So that's for coupons we have. And then we used to get some gift vouchers from our employer, right? Anniversary gift vouchers or birthday gift vouchers. So if you are getting any of these allowances from your employer, it is a great, huge, great or huge, change in your income tax outgo. It will, the impact it will bring. So earlier, for children education allowance, if you used to get from employer, so it was the deductions, what you can claim is 100 rupees per month per child, right? So in total, if I say, so what you could claim as a deduction earlier for your children education allowance yearly was 2,400 only. Now it has increased to 72,000. For similarly for hostel allowance, earlier it was 72,000 yearly. Now it has gone up to 2,16,000, right? So that's the coupons. Earlier it was 26,400 per year. You can claim as a deduction. Now you can claim 1,05,600 as a deduction. Similarly, for gifts and vouchers, earlier the amount was 5K. From now onwards, it will be 15K, right? Reiterating again, so this should not be confused with the ATC section where your kids' tuition fee you get exemption on. So these allowances you can claim deduction only if your employer is giving you, right? Otherwise, it doesn't have any impact on your salary or tax structure, tax deductions, right? Another point to
Gautam,
it
a
is
common
HRA.
question that's coming on the
Yeah.
allowance, the food
Mhm.
allowance, is it applicable under the new tax regime?
No, a new tax regime, it is not allowed. Under old tax regime only. All these are old tax regime. Yeah, sorry, I should have highlighted that.
Yeah.
Apologies about that. So this is all old tax regime only.
Let me do it right away so that nobody misses it.
Yeah.
Old regime only.
Thank you. Sorry for missing that. Thank you. Thank you. Yep. So coming on to HRA, as I said earlier, so only those employees, working in the four cities, Delhi, Mumbai, Chennai, and Kolkata, were supposed to get claim HRA, on 50% of their uh, salary, right? We'll see the computation now. Now, in that list, four more cities have been added: Bangalore, Hyderabad, Ahmedabad, and Pune, right? So, while I was researching for it, I got to know that there has been, on social media, too much hype for this that, now you can claim very good deductions this HRA will bring, right? So we made calculators for this as well to see that how much does it even make impact? If yes, then how much, right? So I'll now again go to my Excel. So Akshat, once the screen is up, do let me know,
Yes, yes, we can see it.
right? So this is the, HRA computation table. Again, you can use this to compute your HRA outgo, right? So your basic plus DA, whatever you get from your employer, is, used for the computation of HRA. So you can get this in your pay slip, right? Whatever the actual rent you are paying, and then actual HRA, what you are getting from your employer. And then there is a computation that how much HRA you can claim it. So it says least of the three things, which I have highlighted here, right? So actual HRA received, actual rent paid minus 10% of your salary, which is basic plus DA, which you put here, right? and then 40% of salary those who are staying in non-metro cities, and 50% of those who are staying in metro cities. So this comes to 3 lakh. So these three amounts you see, right? So these ABC, these three amounts will be computed, will be used for the computation of your HRA. So whatever the least amount will be, that will be used, that you can actually use for claiming the deductions as HRA, right? So as you can see here, 2.5 lakh is the least amount, right? Now assume that, I was staying in Bangalore and working in Bangalore. So earlier I could use 40% of my salary, which is 3 lakh, and then actual rent paid. This computation says 4.25 lakh, and this computation, which is actual HRA receipt, it says 2.5 lakh. So least of the three will be 2.5 lakh. So earlier uh, I used to get the claim for HRA deductions 2.5 lakh. Now, after this change, the point is how much HRA will be will I be able to claim? Right? We'll see that. Right? So this part, 40% salary, now has been increased to 50% of salary. Right? And it is important. When I say salary, it's not your entire salary. It's basic plus DA only. Right? Now let's see. 50% of your salary. Now 40% of your salary was 3 lakh. 50% of your salary has become 3.7 lakhs. Right? But the point is, you will be able to claim HRA, as I said, lowest of these three computation, right? So still the lowest of these three is 2.5 lakh only, right? So you will get 2.5 lakh deduction only, even after the change, right? So I don't think until unless your So until unless your salary changes, and then the rent paid, whatever rent you are paying, it changes. Actual HRA, what you get, it changes, right? It will change. So let's say, for example, the HRA component, let's say I say it has changed. So instead of 2.5 lakh, now 3.5 lakh HRA you are getting, right? You see here, so 3.5 lakh HRA. So this is the 40% wala part, right? If you used to get 3.5 lakh HRA, and then 40% is 3 lakh. So HRA you can claim is 3 lakh, right? Now, if you are getting the same HRA, then 3.5 lakh, you can claim it. So in that case, it would be beneficial because 40% has now been increased to 50%. So it depends that how much is there, how much rent you are paying, how much HRA you are getting, how much your basic and DA yearly is. It depends on these three factors. So don't get rejoiced that my city has been added to the list of original four cities. You'll get automatically HRA exemption. No, it's not like that, right? Yeah. So again, you can compute it. We will share the sheet as well. And don't worry, this particular computation is working perfectly fine. There is no issue with this. Yes, yes, Akshay. So I'll stop sharing. You
Sure,
can
sure. Gautam, just
share
check.
your
I think
screen.
there's a little bit of confusion around the Sodexo meal coupons. I think you did mention it is only for old tax regime, but I believe the Sodexo plus, all of those are going to be applicable for both old and new. Can you check that?
Okay. Okay. 1 second. Let me check it. I'll check it.
There are a few questions in the chat, so maybe you can keep answering them in the chat.
So I think tax is done. So Akshat, I'll check meanwhile this. So you can
Yes.
start.
Thank you, Gautam. So yes, I hope that went smooth. Folks, did that make sense? Did you all understand something around taxes? I know apart from the calculation and the confusion between the old and the new regime for applicability of the Sodexo meal vouchers, everything else good? Are you able to now understand and confident on calculating your old versus new tax regime? Right. So I was actually just sharing that in case, in the meanwhile, while we finish, go to the next leg. Just thought, sometimes people have to drop in the between. So here are few QRs that I was sharing. One is of a WhatsApp community that we've made with Ethika, where, all of you could join and keep asking your questions whenever there is any. It's an open house forum. You can all keep chatting with us. All of us are here, the teams are here, and any questions that you have, you can certainly ask about it. In addition to that, we've also recently started working. We continuously keep putting a lot of content on YouTube as well. So feel free to scan the QR for our YouTube and subscribe to the channel so that you could keep getting more and more understanding. Right? Okay. Now that we are done with taxes, let's move on to investments. And the question to all of you is, are you currently scared with how the markets are performing? Are you currently scared with how the markets are performing? Yes, a bit, but it's largely due to other countries. Our economy seems very strong. Very nice, Nilesh. So happy to hear that comment. Yes, scared. FIIs may not return. Too much scared. Manipulations everywhere in the market. And then few no's. Not really. Wonderful. Wonderful. Okay. Question for all of you. And this is a fun answer only. Okay. No right and wrong answer. This is a fun answers only question. Markets fall. Your portfolio is red. What's your next plan? Refresh the app in every 5 minutes. Close the app and pretend nothing happened. Put it on Google. Is the stock market going to crash permanently? Or message your friend, brother, तूने बोला था safe है. Close the app and wow, so many Furbies. Excellent. Buy more on average. Karthik is putting in the fifth option. दोस्त को पकड़ेंगे says सौम्यकांत. Correct. Okay. Okay. Now, this is one example that I keep sharing every now and then. And this is honestly one of my favorite examples. For those of you who are getting scared with the stock markets, I have something to show you all. Right? Just give me 1 second. Yeah. I have something to show you all. Now, here is a simple calculator. Sorry, here's a simple data that we've pulled up for one of the mutual fund schemes. And we've tried to plot that data for the last 25-30 years, right? Abdul says close app and eat biryani. Yes, absolutely, Abdul. Okay, coming back to this, right? I got distracted with the word biryani there, so I had to read that comment. But yes, so what we've done is in order to see how the markets have worked over the last 30 years, 25, 30 years, from 1996 to 2016 now, so exactly 30 years, we've plotted this data. And let's just understand this from a very simple example. Suppose you had invested 10,000 rupees into this XYZ fund in the year 1996. What would the journey look like? So in 1996, you had put 10,000 rupees, and actually, the as soon as you invested, you would have lost 50 rupees. So from 10,000, it would have gone down to 99.50. On then, okay, then over the years, it would have gone up and up and up, a little further up. And for around 2000, 2001, this same 10,000 rupees had gone up to all the more to 23,000 rupees. Huh? And do you remember there was a dot-com bubble in 2001, 2002? Stock markets had actually crashed completely. And that's what happened with your fund as well. What had gone up to 23,000, it came down and down and down, and it came down to almost 11,000 rupees by the end of 2001. Right? And you were like, I invested 10,000 rupees. It had gone to 20 to 3,000 rupees, but 11,000 is back where I am. Okay, okay. But did it go to zero? No, it did not. Right? Let's look at further. Let's look further. From 2001, if you stayed continued invested, you did not really take out money. You continued staying invested, and you went up and up and up. And by 2007, 8, your 10,000 would have become 1,70,000 rupees. 1,70,000 rupees. And then once again, what happened? The 2007, 2008 global financial crisis happened, right? And once again, stock markets, kind of came down. They crashed, and what had gone up to 1,70,000 came down to 93,000 rupees. Again, many of us panicked at that time, took out our money. Some of us continued to stay invested, and then we continued staying invested, invested, invested. You see, the money kept growing, and it went almost to about 5,18,000 rupees. 5,18,000 rupees, 5,02,000 rupees in the June to December framework of 2019. And then once again, COVID hit. And what had gone up to 5 lakh rupees came down to 3.5 lakh rupees. But again, we know what happened post COVID times. I'm sure almost everyone who's on this call has has witnessed what had happened during the COVID times. Markets did fall down again, but once again they came up and up and up. And today, the value of that 10,000 rupees is close to 10 lakh and 23,000 rupees. Just one 10,000 rupees, no SIP, no more investments, just one time deposit of 10,000 rupees. In fact, it had gone up to 12 lakh rupees as well. Yes, markets have not performed for the last 1.5 years, and so therefore it's around at 10 lakh rupees. But are you getting what I'm trying to say? Just going back to that graph of COVID crisis. But now see, when I look at these graphs individually, I see huge ups and downs. Huge ups and downs. But when I actually look at this graph over a 30-year period, can you believe it? We don't even see 2001, 2000 as a downfall. Very slight. 2007, 8, okay, a little bit. But then up and up and up. 2020, down, but then up and up and up. And then same things repeating here. Are you getting the point that I'm trying to say? What I'm trying to share is this is the power of long term investing and consistency. You do not have to be scared with markets. Yes, if you're investing in it for the short term, it could be very dangerous. And therefore, there is a very valid question. There is a very valid question. Akshat, what if I had started in investing in 1996 because I wanted some money in 2024? Then my money had reached almost 12 lakh. At that time, I would have, and then it came down. I would have lost this. I would have lost this. Why? What does it, then it does not solve any purpose. Now tell me something. 30 years earlier, you had started investing for a goal which is in 2024, 2025. Now, when you were in 2022, 2023, was that goal still a long term or did that become a short term? Short term, right? And so, when you were nearing that goal in 2024, 2025, would that not have decreased? Should you not have taken out your money from equities and started putting them more towards fixed income assets? Correct? That's what I wanted to share with this. That is the power of long term compounding, and that's the importance of rebalancing your portfolio as and when time comes, right? So if you feel that you are about to, you need to use that money for the next 1.5, 2 years, you are no longer in long term, and so you should not be invested in equity. Rather, you should be withdrawing that money and putting it towards debt or putting it towards fixed income schemes. Correct? Does that make sense? Somebody is asking what about inflation? Inflation would have grown to about 6%, 7% for sure. Right? But is that in your hands? No. What's in your hands? Investing. Here's another very, very, very interesting analysis recently shared by a very known person, Monica Helen. Anyone who here does understand knows Monica Helen? She was one of the first she was one of the first journalists on personal finance, one of the first editors to write articles on personal finance. And there is this beautiful analysis she's done, right? Now, for a second, don't look at the screen. You might find it confusing. Let me first share it with you. What she says is, let's say if you were the worst investor ever, the worst timing investor, which means that over the last 30, 35 years, you invested every year, you invested 1 lakh rupees every year, but whenever you invested, the market was at an all-time high. So she took the 52-week highs of every single year. And she said that if I was the worst timing investor, the unluckiest investor, I think unluckiest investor is the best word to say this. If I was the unluckiest investor, which means I bought all my mutual funds or all my securities, or I bought Sensex, basically the index, if I bought it at a 52-week high every year, you know what? The unluckiest investor would have still made a 10.5% return. Even if you were the unluckiest investor every single year for the last 30 years, you would have still made a 10.5% return. Can you believe that? Are you able to understand or visualize the power of that? For 30 years, you did not invest in anything else but this. You were unluckiest, but you still made a 10.5% return. The point that I'm trying to once again make from here is this is the power of long term investments. This is the power of long term investments, right? So let's quickly look about investment planning for the FY26. Let's understanding, reviewing, rebalancing, and optimizing our portfolio. And before we do that, we wanted to quickly share some framework with you that we deeply believe in, right? We feel the journey of building wealth can majorly be divided into three phases. Can majorly be divided into three phases. Journey 1, which is our 0 to 1 CR journey. Journey 2, which is our 1 to 5 CR journey. And journey 3, which is our 5 to 10 CR journey. The biggest drawdown, yes, Karthik, absolutely. The biggest drawdown ever and still 10.5%. Right? Okay, coming back to this. So 0 to 1 CR is the first journey, 1 to 5 the second journey, and 5 to 10 the third journey. And I'm assuming most of us might currently be in the journey of 0 to 1 CR of financial assets, right? I'm not counting houses here, right? I'm not counting real estate here because, again, anyone who owns a real estate is already a crorepati, right? There's nothing in this entire country which we can get for less than a crore, I believe. But for now, I'm talking about financial assets only, right? So the point that I was trying to share is most of us make a lot of mistakes in the first 0 to 1 CR journey. And so, what we wanted to what we feel is if we get our first 1 CR journey right, it is very easy for us to get the remaining right. Right? And therefore, we thought, why not break this 1 CR down into 1A, 1B, 1C, 1D, 1E, which is the 5 lakh goal, 10 lakh goal, 25 lakh goal, 50 lakh goal, and then 1 CR goal. Right? And you'd be like, Akshat, it is slightly impossible. I don't think we can get to 1 CR. How many of you think that? How many of you think that it is very tough to get to 1 CR of financial assets? Anyone who thinks so? Okay. So what we are going to now do is, we're going to do some calculations. We're going to have some fun. Okay. I'm going to put 1 CR here. I'm going to put 1 CR here. My expected rate of return is 12%. Okay. You all saw the unluckiest investor can get 10%. So I think I can get 12%. I am not very unlucky. Maybe little bit of luck will prevail for me. Little bit of luck will prevail for me. Okay. So now, if I have to make 1 crore in the next 10 years and I am able to get a 12% return, what I need to start with is an SIP of 42,000 rupees per month. I need to start with an SIP of 42,000 rupees per month. So if I today start investing 42,000 rupees per month for the next 10 years and I get a 12% return, I will be able to make my first 1 CR. Yes, no, doable? Do you think this is possible? Vijayji, I know you're talking about inflation, but let me just tell you, all of these calculations need to be done without inflation. You cannot you cannot think about inflation when you're planning for your investment. Because when you're trying to invest, you're trying to earn more money so that you can beat inflation. Right? So I would suggest you keep inflation at a side. First talk or think about how you can make money grow. How can you earn interest on that money and then talk about inflation and then talk about taxes as well. Okay, yes, Saksham, only 42,000 rupees. Yes, Vijay, absolutely. But okay, step up I have not even put right now. Step up I have not even put right now, Ravendraji. So this is 42,000 rupees year after year, year after year. Yes, Jigyasa is absolutely right. 12% you will not get in 2 to 3 years. I have taken this as an average. If you are invested for the first for 10 years, then on an average, Jigyasa, I will show you some numbers. Getting 12% is very much possible. Now, some of you I know, are still saying, Akshat, no, it's still not possible. It's still going to be very, very tough, right? And so, for those of you who feel it is going to be tough, let us do something. Acha, for now, you will have some savings at least. You will have some money saved. You've been working for quite some years now. Can I say all of us on an average have maybe 3 to 4 5 lakh rupees saved, at least somewhere, maybe in FD, maybe in some mutual fund, or maybe just in our savings account? Tell me some number that I can take. 5 lakhs, is that okay? 5 lakhs, okay. Okay, some of you say no, say, okay, I'll take 3 lakhs. I'll take 3 lakhs. So if I take 3 lakhs in lump sum, this value drops down to 38,000 rupees. Meaning that if today I have 3 lakhs, I need another 97 lakh rupees to make my first 1 CR. If I now start with just 38,000 rupees, I can be able to reach that corpus of 1 CR in the next 10 years. Brought it down? Let's try to bring this even further down, right? And somebody said, what is step up? So there is something called as step up that we've added. Let me say that what if we step up with 5% every year? And step up means that I start with an amount, but I promise myself that every next year, year after year, as my salary increases, as my understanding about money increases, I will try and step up my investment by 5% year on year, right? And let us look at this number. If I step it up by 5%, my number drops down to 31,000 rupees only. Does this now look doable? Does this now look doable? So what this means is year one, I do 31,000, approximately 32. Year two, 30, I top it up by 5%. Year three, I top it up by another 5%, so on and so forth, right? So I'm basically increasing my investment every year, right? If I increase it by 10%, it falls down to even further, 26,000. But okay, you might, I get the point that it's tough to increment it by 10% year on year. So we'll keep it at 5% for now. Okay. And you know what? For those of you who feel it is still tough, what if instead of 10 years, I know 10 years is something which could be very competitive. What if we do it at 15? 15 might be a little comfortable. Let's look at some numbers then. It drops down to just 12,000 rupees, my friends. 12,000 rupees a month, and you will be able to create your first 1 CR in the next 15 years. Does that now make sense? Can I now say it's now going to be very, very, very easy to make our first 1 CR? The point once again that I'm trying to share here is we all start investing, we put into SIPs, we put our money here and there, but we don't really think about the end goal. And that's why today, with this framework, we want to pass on this end goal to you so that now you can start looking at the future and you can think, okay, my first goal to myself is going to be, first major milestone is going to be 1 CR of financial assets, right? 1 CR of financial assets. SIP per year. So this lump sum that I took, this is just one time. If you, whatever money you have total so far, that's it. You're just putting that one time. So you all can do the changes and calculate it for yourself. And then this is SIP per month, right? This was just calculation. We broke it down into SIP per month, right? And now another thing, yes, don't worry, you will all get this Excel. We've created these Excel sheets only for you, right? And now there's just one more thing that I wanted all of you to understand, that as much as you should target for 1 CR in the next 10, 12, 15 years based on your current salaries, you can also break these goals down into further, right? So let's just look at what would 5 lakh rupees in the next 2 years take us to do. Sorry. With only 4,000 rupees, and I already have 3 lakh rupees. So with just 4,000 more rupees, I will be able to achieve 5 lakh rupees in the next 2 years, right? I will be able to collect another 2 lakh rupees. Same way, 10 lakh in 4 years. We'll just change these numbers. And I hope you understand what I'm trying to do here, right? I'm trying to give you all a way to reach to your 1 CR, right? So 4 years, 10 lakh, just 7,600 rupees, right? And same way you could make a plan for all of this. 1 crore is not that tough as it looks to be. It is really, really possible to do it. ठीक है, perfect. Now your bigger question, what does it take to reach 1 CR, Akshad? Where should we invest? And I feel the plan should be very, very simple. You should kiss your financial plan. Anyone who can tell me what's the full form of KISS? KISS. You should kiss your financial plan. What could. Yes, absolutely. Keep it super simple. Keep it simple, stupid. Keep it simple, silly. Absolutely, right? So, what do you do? Very simple 100 age rule. What is 100 age rule? It says, let's say, suppose today you are at 30 years of age, 100 minus 30, 70. 70% of my money should go towards equities, 30% of my money should go towards fixed income assets. Right? As simple as that. We'll just show you some sample investment plans that we've made for you. A sample portfolio of a 30-year-old, 70% that I have to invest into equities. Now that 70% we've given you the breakup. Okay, so you could take a screenshot, take a photo, or don't worry, we will obviously share the slides with you. And I will also share some additional videos for your reference so that you can understand it even well. And so equity, mid cap 25%, small cap 10%, flexi cap 20%, and some stocks, if you want to invest in, you could be investing about 15% of your money, right? So what I'm trying to put here is, now whatever amount this is coming out to be, say 31,000, you are targeting, you can invest 31,000 rupees. Out of this 31,000 rupees, you should divide your 31,000 into this way, right? 25% of your, so 70% of your 31,000 should go towards your equity investments, 30% should go towards fixed deposit and gold, silver, right? And out of that 70% of your equity investments, 25% in mid caps, 10% in small cap, 20% flexi cap, and 15% in stocks. If in case you feel you are not somebody who can understand stocks or finds it tough, then that stocks portion, that right side stocks portion, that you can change it into an index fund or a large cap fund, right? Large cap fund is also good enough. What type of index funds? Any index fund matters. Any index fund. Any index fund I would go. Index funds in India, right? Any Sensex or Nifty. So that's that. I was about to come to that. This is, So you see, I just randomly opened. Okay, no affiliation with ICICI Bank. I just randomly opened the whatever the first link came, and here are all the index funds that have come up. So index fund, I feel, is one of the best ways for you to get started with your investments. Index fund is nothing but Index fund is nothing but your money being put into the top 30 or top 50 companies of our country, right? So a Sensex index fund would mean investing your money into the top 30 companies of the Bombay Stock Exchange. A Nifty index fund would mean investing your company into investing your money into the, yeah, I've actually put a slide here. So investing your money into the top, so Nifty is top 50 of the National Stock Exchange. Sensex is top 30 of the Bombay Stock Exchange, right? That's how you go about it. Karmuri is saying only 10% for small cap. Yes. Why? Because I feel you need a much longer time period for small cap, right? So even 10 years for small cap could sometimes be very, very, very tough. And again, we've put up these slides more from the understanding of somebody who's new to investments, not very, very experienced. If you feel you are experienced and you can handle the risk with small cap, feel free to go ahead with that. But usually the time period that you should take for small cap is about 15 years, 15 to 20 years. Now, there's just one more thing that I wanted to cover. We did cover it previously as well, but if I don't know if we have the time, but I will. So, this is for all the investors who've always been thinking, okay, right now market is down and I have some extra money. How should I invest? Should I buy more? Should I buy more? Anyone who's here who's thinking that how to buy the dip? So for them, we have a strategy. Okay, since there are quite a lot, do you want me to cover a strategy? Okay. So for that, I will quickly share something that we've come across, right? Yes, I used to invest more while market is down. Absolutely, Ravindraji. The question is, how do you decide how much to invest more? Okay. Now, there is something called as sorry, okay. So there is this very famous person called Dr. Bernstein, right? He actually, let's read this slide from bottom up. Okay, look at the bottom two points that I've mentioned. Dr. Bernstein has written over 10 plus books. How can we find the bottom? Nilesh, go down. I'm saying to read from where Dr. Bernstein and caution is written. Okay, so the first one, caution. This is supposed to be only used as a guideline. It is not a rule and it is for an experienced investor only. Okay. In fact, I would strongly suggest you read the book that Dr. Bernstein has written and then take these into consideration. Right? He has written over 10 plus books on investing, frequently interviewed on CNBC, and handles more than 25 million portfolio. Right? Now, what I'm trying to explain through this slide is Dr. Bernstein says that every time the market falls, you buy 1/5 of how much it has fallen by. Okay? I will try and make it super simple for all of you to understand this even better. Let's suppose today you have 10 lakh rupees. Okay. Now listen to this very easy, very simply. Listen to this, very carefully. Listen to this very carefully. I'll go step by step. Wherever you don't understand, just stop me. Total portfolio value is 10 lakh rupees. Equity, let's suppose right now your total amount of savings is total of 10 lakh rupees. Out of which 60% is in equity, 40% is in debt. Let's suppose there was a 20% market crash that happened. How do you know that? Let's say there was Sensex was at, for example, 70,000. It fell down by 20%. So that means there was a 20% market crash. With me? Now, before crash, you had how much money you had? 60%, which is 6 lakh rupees into equities. After crash, since the market has fallen by 20%, so obviously your investments have hit by 20%. So if they are hit by 20%, your 6 lakh rupees will become 4 lakh 80,000 rupees. Correct? And so that means 4 lakh 80,000 rupees, your equity percentage is now in about 48%. Correct? With me so far? Now, what do you do? So Dr. Bernstein says that every time the market crashes, you should buy or you should try and increase your allocation by 1/5 of the market crash. So if the market has crashed by 20%, 1/5 of market crash is how much? 4%. Correct? Correct? Now, simply 4% of your SIPs is what you should increase, or 4% of your allocation is what you should increase. Right? So 4% before crash, 2.4% of your 48%, 2.4%. So you top it up by 14,400 rupees. Right? 4% of the, so 1/5 of the market crash. So 1/5 of the market crash, how much was the market crash? 20%. So what is 1/5 of 20%? 4%, right? Correct? And so 4% of your existing investment. So if your existing investment was say about 60%, it is 4% of 60%, which comes to be about 14,400 rupees, right? So 4% of your existing investment before crash. Correct. Correct. 4% of your existing. So that is 2 point. So 4% of your existing investment, which is 4% of 60, which is 14,400 rupees, right? So now generally, if you would rebalance, you would only balance it. I mean, you will only bring back your 48% to 60%. Following Dr. Bernstein's approach, you actually do it at 62.54%. So instead of rebalancing or putting 1,20,000, you now put 1,34,000 rupees of money more into equities. So once, first and foremost, this is only for existing investors. If you are new to it, if you are investing for the last only 5 to 7 years, I would say don't even think about it. You can close your eyes. You should not worry at all, right? You should not worry at all. But if you are somebody who has a lot of money invested into the markets and now you're looking at buying the dip, then buying the dip method, for buying the dip, there is this guideline that you can follow, right? Usually, what would happen is, suppose you are at a 60%, 40% allocation, right? We saw the 100 age rule. If you are 30 years, 70 30. If you are 40 years, 60 40, right? Now, if you are at 60%, you suffered a loss of 20%. Your 6 lakh rupees fell down to 4 lakh 80,000. Now, so the usual case would be, okay, I should put in 1 lakh 20,000 rupees more into my equities so that I can buy the dip, right? That's the usual framework that we see everywhere. Anyone who says, okay, jitna bhi kam hua hai, utna aur le lo, you buy the same amount more so that you have more equities in future and you are able to take advantage of the market. Dr. Bernstein says that in addition to that, you should also purchase for 1/5 more of the market crash, right? So that gives you an advantage, a slight advantage, and the long term portfolio compounding works even better for you. Cool. In rebalancing, will any tax be deducted? Uh, no. So you're not selling anything, right? You're basically investing more. So Raman, no tax. You're investing more, right? You're putting in more money into the markets. Maybe a little bit for everyone. And so we will certainly share the video recordings as well as the slides, the PPTs, everything, so that you can actually learn this better. Cool. But yes, do be a part of the WhatsApp community as well as do follow us on YouTube because we are actually putting out a lot of content. In fact, some of you were asking me if I'm a beginner, how do I go about it? I will just quickly show you what we've done. And in the meanwhile, I think Ankit has put up the poll so you could answer that. But I will quickly show you what we've done on our channel, right? So here is how our channel looks. And this is what we are doing. We are creating content if you are in your 0 to 1 CR journey. And that's why we've put up in big capitals Mission 1 CR. We really want you all to create your 1 CR. We recently completed our 1,000 subscribers as well. And now, what for the purpose of why I was sharing this, if you go on to playlists, we've actually put up two good playlists. So one is this fundamentals of personal finance, which is a extremely detailed course on anything and everything personal finance. And then one is on mutual funds. It's a subset of the same course. It's a subset of the same course. Okay. So this is your fundamentals of personal finance. You have anything and everything that you can learn about finance from here. And then this is only for mutual funds. Somebody who is new to mutual funds wants to understand what mutual funds is all about. This is what you can go. There are about 10 videos so far. We are continuously adding more and more. We are also adding videos on how do you find the right fund, what parameters do you use in order to select, so on and so forth, so that you get understand it better, right? Vrishabh, allow us some time. I will just check with the team post this session and I will let you know. You should shortly see an email from Ankit as soon as the sheet is fixed. He will be sharing it with you, right?
Yeah.
Okay. Otherwise, you can always join the WhatsApp community and you get access to things even faster there, right? So as soon as it is fixed, we will announce that it is fixed there.
Yeah, Akshay. So, what all services that you provide? Like, do you help with the like investing in the market? Like, yeah, would like to know about your
Sure.
services. Hmm.
Sure. No, no. So Nishanji, a long story short, we are building a school of personal finance. So we are actually financial educators. As I started with the session, Pennywise is purely into educating only. And as of now, we are majorly focused on creating content around mutual funds, investment schemes, insurances, so on and so forth. Stocks is something that we've still not gone into. Hopefully, we do that based on the feedback that we receive. But yes, I mean, apart from that, if you need some services, we are happy to introduce you to certain people who do that for a living. But we do not do that under the umbrella of Pennywise.
Okay, thank you.
Mihir's question is on will you be able to share a plan for 50 years of age? So, Mihir, you will get this Excel sheet, right? All you have to do is just redo your numbers as per your 50 years of age, and you will be able to get that understanding. Let me actually do something. I will see if I can, at least for this group, share just allow me a second. I will see if I can. Yeah, I think Gautam had some network issues, so he should be back on in a minute. I'm just waiting for him to answer the tax related questions. I myself always confused with taxes, so that's why I prefer.
Yes, Akshat, I'm back. Yeah.
Hey,
What are the
Gautam.
questions?
Yes. Are you able to access the Q&A part? Or
One
let me
second.
read it out. What's the difference between tax outgo and ITR from a salaried person's perspective?
There's no as such difference actually. Tax outgo is simple. So this is the word actually I use more frequently than tax payment. So tax outgo is simple. That how much tax you'll have to pay. That's it. There's no
Uh,
difference
by act,
actually.
yeah, by actual HRA received, you mean the HRA component allowed in the salary structure, right?
Yes, yes. So actual HRA. So when you open your pay slip, in your pay slip it will be mentioned house rent allowance or HRA. So the amount will be mentioned there. So the amount which you actually get from your employer. So that is actual HRA received.
Does husband have to show proof of income if investments are done in the name of wife?
Yes, actually, if you are doing investments in the name of your wife and your wife or the spouse doesn't have income, then income tax department might ask, because as you don't have source of income, so as your spouse, basically your wife in your case, she doesn't have source of income. So if the amount is huge, then typically what happens is, the investment amount is not that great, so that it comes under the lens of taxman, right? But if the amount is huge, if you are making huge amount of capital gain without any active source of income, then income tax department might question you actually. Then in that case, your wife's PAN basically, it might question that without having any active source of income, how could you, make such a huge amount of capital gains? And then in that case, it will be attached to your PAN basically.
Okay, and the last one is let out available in new regime to reduce gross income.
Yes, yes, let out is available. Self-occupied is not available. Let out is available in new regime.
Yes, so Mihir, when you have the reason why you have a view only is because if everyone makes changes to the same slides, we will all see your data, right? So what you have to do is there is an instructions tab in the first tab. Just allow me a second. Yeah, there's an instructions tab as you can see. All you have to go is go to file, make a copy, and then obviously you will be signed in with your Google Drive. When you make a copy, like just click on make a copy again, and it will copy this Excel as your personal use, right? So that's how you will be able to get it. Nishant's asking, please include SIF, MF in your YouTube. I'm about hardly any video in simple words. Right, right. Nishant, the reason why you don't find too much content there is because SIF is still very new. And I'll be honest, right? Even I have personally not put in my money in SIF yet. So I create videos only when I've put in my personal money into something because then I feel it becomes easier for me to explain it further, right? So as of now, I have not put my money there, still new, so therefore exploring whether it should be used or not. Don't think of us as any influencers. We're just trying to share what we've learned. How much money can be redeemed that is tax free? Rama, I'm not sure if I get your question. Could you please also share the link to the new versus old regime? Shivam, you will get that link very shortly on your email. Not sharing it right now because it just needs some correction and then you'll be confused with multiple copies. We'll share it with you shortly. If you're already on the WhatsApp group, we'll share it on the WhatsApp group as well. If not, Ankit will be sending you an email very soon. Yes, yes, Rama, you're right. So when you sell, correct, correct, correct. Okay, I got your point. So whenever you sell your investments, there is something called as capital gain tax. Up to 1,25,000 rupees of profit is something which you can get tax free, right? So you don't have to pay any taxes on that. So up to 1,25,000 is the exempt. On top of that, then there is something called as tax harvesting. You basically sell off things in your loss versus sell off things in your profit, and the together profit minus loss, right? That total calculation should not be more than 1,25,000. That's what tax harvesting is. But just to simplify it, 1,25,000 of total gains in a year is tax free.
So, to everyone who joined us today, thank you for showing up for yourself this Friday morning, and your questions were great, and the energy in the room was wonderful. And big and heartful thank you to you, sir, for this time and his warmth. And every time you come up with same energy, same excitement, and the content that we getting is far better than what we have getting in the last session. So have a fantastic weekend ahead. Go make some smart money moves, and we will see you at the next one. And we have, as we have already shared, the WhatsApp community group. So please join in and ask whatever the questions that you have in your mind. Sir will be able to answer those questions.